You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means we are back once again for Education Wednesday. It is time for a rare live huddle edition of Options Playbook Radio, the program for you out there, the busy retail trader. Maybe you want to learn more about how to generate some income, maybe some capital appreciation. You want to go on offense with your options plays, and maybe you want to play a little defense. You want to lock in some of those gains you already have. Maybe you're a little spooked by the downside we've seen out there in the market over the last few weeks. You want to go on a little bit of a defensive spree. Who can blame you? Either way, we've got you covered here on Options Playbook Radio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding you, if you're just listening to OPR, you're missing out on a whole heck of a lot of content. So wherever you're getting this show, make sure you upgrade to the full network feed. That'll get you other shows like Options Bootcamp, very much a sister program to this one, focused very much on education. Of course, the option blog and volatility views and This Week in Futures Options, and you name it, the crypto rundown. The sky is the limit. Usually a couple of shows coming at you a day. And then if you want to go above and beyond, you need more options content in your life. You want exclusive pro Q&A sessions, as well as options oddities to end the week, as well as live access to everything we do here throughout the week, as well as awesome giveaways like our pro trading crates. That next one's going out pretty soon. How do you get your name entered in those giveaways? Theoptionsinsider.com/pro is the place to go to learn more. And enough of that preamble. It is time to welcome on your usual host for this program, Mr. Brian Overby, a.k.a. the Options Guy. Mr. Overby, welcome back to your own program, sir.
Well, it's great to be back, Mark. And like you mentioned, we don't do this enough, where we get together and answer some of these listener questions. So let's say it's time to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody. Welcome to the huddle. Of course, the portion of the show where you folks ask us questions. You take the reins. Sometimes we turn that spotlight back on you folks. Like we're doing right now, our question of the week is live, and I want to get Brian's thoughts on it. Our question this week, it's actually going back to something we asked you earlier this week. We've been tracking all of the results of our questions of the week, and some of them are kind of interesting. We asked you back in the June timeframe about what levels you were looking to buy back in on the market. Of course, we saw a sell-off back in June as well. And at that time, about 40% of you, actually a little over 40% of you, said that you were waiting until the S&P dropped below 3750. That was your level where you're going to start nibbling. You're going to start BTFD and buying that dip. So now we thought, let's revisit that question a few months later. When we posted this back on Monday, the S&P was almost 100 points below that, 3660. We have, of course, rallied today back north of 3700 again. But our question is now the time? Are you back in or are you waiting for lower levels? Gave you a third option as well, which is I never got out, which means you've been riding this market all the way down. I don't like to see those results, but sometimes that is the truth. Mr. Brian, what do you think our audience is voting for right now, sir?
Never got out. I think that's where they would be at. When I see the words "I'm back," that just gives me a little bit of the shakes, considering that was the phrase that Cam Newton used here in North Carolina when he became the quarterback
for
again.
Your Panthers. Yeah. Auspicious debut that was.
Well, they're not my Panthers because I'm originally from Wisconsin.
That's true.
They do live here, so
you're
by
a
default,
Pac-Man.
I guess.
You're a Pac-Man.
I'm back.
You were reveling in that whooping they gave the Bears a few weeks ago.
So I can't go in. Yeah, and that is true too. But so I can't go for I'm back. It just that kind of gives me scary dreams. So I'm going to say never got out.
Oh, that's kind of cynical. You think a whole bunch of our audience is just riding this market all the way down.
Well,
I hope you are wrong.
I guess I'm going to go this way with it. I'm kind of hoping that you are willing to ride the storm, because I'd hate to see people get out without a plan as to when to get back in. And that's always what scares me the most about this. And it's, that's a question by itself. If you say I'm getting out and I'm bailing, then when are you getting back in? When the market comes back 10%, 15%? Where's that number that you decide to get back in? And so many times people just miss out on the upside because when it does come back, it has a tendency to come back fast.
Well, our audience, sir, they're looking for deals. 71.1% saying they're waiting for lower levels, Brian. So a 37.50, even where we were the earliest week, 36.60, not enough for them, sir. They want a little bit more downside before they're willing to start BTFDing. 17.8% of you said you're back in, so this is the level you've been waiting for. You've started to nibble again. And this number is growing, which is a little bit alarming. This was Brian's choice, 11.1% for I never got out. That was only 7% this morning. So a lot of you folks have been riding this down. Hopefully, you've been listening to shows like OPR or Options Bootcamp, some of our other shows, and we've helped inform you about some strategies you could use to at least mitigate the pain. Remember, you can't just ride the elevator up and ride it back down again. You got to do something in between there to help at least soften the blow a little bit. So hopefully you've learned a little bit. If not, I encourage you, check out the defensive plays there in the playbook. They're all there for you and pretty accessible. All right, Brian, let's get out to the folks here now. Some of your people have been waiting very patiently for us to do a huddle again. We got to do more huddles, Brian. The folks are active. They want to get at you. Just go out to Ethan. Poor Ethan Gwynn, or maybe Gwine. He's been waiting for a while for his answer. Ethan wrote in. He says, Brian, I have a question about credit spreads. I heard you state on a previous podcast that you get out of credit spreads the day before expiration if the spread is in the money. And he puts in parentheses, i.e., you're taking a loss. So yeah, if it's hitting you, you're getting the heck out of Dodge, cutting your losses. What if you have a profit heading into expiration? Do you cut bait and take the profit a day before expiration, or do you wait until the day of expiration to close the trade? Love your work, Ethan. So Ethan's obviously a fan, Brian. We got to get him his answers faster. Sometimes when people send in stuff to this show, I know we're not going to have a huddle for a while. I make sure we get him at least an answer on another show first while they're waiting for this show. But now he gets his official answer, Brian. What do you have to say for Mr. Ethan?
Well, I do it a little bit more off of the price. You say that you take the profit the day before. I have no problem taking a profit. And actually, we looked at Netflix credit spread. I thought maybe this is what this was in reference to. It was a credit call spread, and we learned our lesson. Netflix and that was a couple weeks back from the taping. But when we looked at that trade, the stock went straight down, which is what you wanted to happen on a credit spread. And all of a sudden we turned around, and your 2 days before expiration, the stock ran up 20 points. So it was a profitable trade for a long time, and it was a 50-cent net credit to the account. So, let that be a lesson to you. If you didn't get out, the trade is now not profitable. And I just looked at a quote on it today. That same spread is now trading for 80 cents. We sold the 250 strike and the stock's at 245. So yeah, if you got that opportunity, I very rarely, if I can get 80, I'd rather do it this way, Mark. I'd rather say it. If I can get 80 to 90% of the net credit, and it depends on the underlying when I say that, but if I can get 80 to 90% of the net credit on any credit spread, I would always consider taking it off without looking at the days to expiration. So I sell it for $1. I can buy it back for a dime to 20 cents. Then I'm okay with that. I'm okay with that. And that's kind of the way that I'm going to approach it on the profit side. Now, if it's going into expiration, well, one of the things that I always do on short spreads is if the stock or underlying gets in the money and my long option contract, if I'm on a short spread and I'm either a put or the call side, the long option contract means that it's gone all the way through the spread and is sitting on it. I'm almost always going to get out in that scenario. I don't, mainly because I'd be selling my long at the money option contract. So that's just a general rule of thumb. It will obviously depend, exactly where we are in the expiration date. But I want to be able to sell an option that's at the money and get my most bang for my hedge that was trying to protect me on that trade. So if it is going against me, it's more about price. If I sell it for 50 cents and it starts going against me, I'm not really looking at days to expiration. A general rule of thumb would be if you lose what you could have made, the maximum. So if I sold it for 50 cents, I might buy it back for $1, or I sold it for $1, I'd maybe want to buy it back for $2. That would be the concept. So I'm going to set a line in the sand as opposed to a day to expiration if I'm going to try to manage this trade. And that's the way that I would approach it.
Yeah, I don't think we've ever said on this network, I don't think we've ever counseled people to hold trades until expiration. It's usually the opposite, right? You take them off.
Right.
I can't remember the last time I said, hold that all the way until expiration. Usually bad things happen when you do that, Ethan. And yeah, Brian's right. If you have a profit, we've never been shy, never been reticent about telling you to take that profit, live to fight another day, never went broke taking a profit, all the old cliches. The other way around, of course, pigs get fed, hogs get slaughtered. You have that profit. And if you're waiting till expiration to get that last dime or whatever it is out of whatever you sold, let's say you collected 50 cents, $1, but then you're waiting for that last nickel, that's when things inevitably go awry, Ethan. So you probably 9 times out of 10 are going to want to close these things out before expiration anyway, let alone if you have a profit. Yes, sure. Take the profit, get the heck out of Dodge, live to fight another day, and you do so with fuller pockets. What's better than that? Nothing, right? Nothing at all. All right, let's go out to this question from Ray. This is actually an interesting topic, timely one. We were just discussing this on Options Bootcamp earlier today, the sister program to this one, with Mr. Passarelli over there. Ray wants to know, from a timeline perspective, what is the proper time frame to buy a butterfly? If I buy a 3 or 6 month butterfly, is that too long of a time frame? Brian, like I said, this is something we were just discussing on Options Bootcamp earlier today. It seems like butterflies are hot again. Iron condors, iron flies, all these spreads with wings are hot right now. A lot of debate about the proper time frame to utilize a butterfly. I have my thoughts on it, but I'm curious for you. What is your optimal time frame for a butterfly? Are you a long-term fly guy, or are you more of a short-term, within a month kind of fly guy?
I would be on the short term. And my rationale, if I'm going out 6 months in time, even 3 months in time, I'm really trading implied volatility moves more so than time decay. Because if I'm in an expensive underlying and I'm trading a 6 month fly and it goes to my strike, I really need implied volatilities to come down to get paid, because the biggest thing about a butterfly is that you're selling 2 option contracts that if you're right on your forecast, they're going to be at the money option contracts, and they're going to hold a lot of time premium. So it's really hard to be profitable specifically on a butterfly until you either get some time decay on those option contracts, if you're correct on your forecast, that is, or you get a decrease in implied volatility. So with that said, a lot of times if I'm doing a longer fly, I'm going to do it because I'm bullish on the call side of things, where if the market does go up, I would expect implied volatilities to go down, which is the norm. And I would be less likely to do this longer term butterfly on the put side because of everything that I just mentioned. So I think a lot about butterflies doing a more short term because they are minimal risk. By doing that butterfly and adding that wing in, the time value can hurt you on a butterfly going that far out in time.
Yeah, that's exactly where I come down on. I'm very hard pressed to do a butterfly beyond, let's say, a month, right? For the reason you just described. How many people write into us all the time, Brian, saying, oh, I did a butterfly on whatever the case may be, XYZ name, and I got the move, and then my fly is not worth much more than when I bought it. And you'd say, well, how much time frame did you put on it? Oh, they went out a substantial way. And you always say, that's your first problem right there. You need that time decay to come out. You need that vol to come out so those spreads can widen out so you can actually get that max value or close to it for that butterfly. And obviously, you're never going to get max value. Brian says that all the time on this show. If you're trading butterflies, you have to have some reasonable approximation of how much profit you think you can reasonably make, because you're very rarely going to have everything line up, get that perfect bullseye so you can get 100% max profit on your fly. And the longer you're going out, you're just going to be disappointed because you get that big move and then you're just going to be sitting there waiting for the time decay to come out and for your spread to catch up with the market move. And by that time, who knows what's going to happen? The underlying could move back the other way. And that's the most heartbreaking thing. You were right in your forecast and everything else. You just had the wrong construction with your trade. And as a result, you weren't really able to capture it. And by the time you would be able to, the underlying has moved back to where you started and you've lost all that profit potential. So we don't want to see that be you, Ray, or anyone else listening. Try to keep your flies shorter duration whenever possible, but not super short. They have people ask as well, Brian, what are your thoughts about extreme short butterflies, day of expiration fly? That seems to be a hot thing now too. What are your thoughts on those, sir? The other side of that coin.
Well, I have done it, and I have done those type of trades where we get the short flies, and it's because market conditions go with it. So that's what Options Playbook Radio is all about. So where was a situation that I talked about a butterfly on a specific underlying? Amazon has usually announces earnings every Thursday during earnings season. I don't know why they picked Thursday, but you have a lot of juice, especially when it was a $2,000 stock. And Friday, and you have one day for those option contracts to live. So because of the juice, the butterflies would become cheap. Higher implied volatility means you're selling those two option contracts. You're going to get a lot of premium for them. And all that premium has to come out in a day. So speculative, yes. Manage risk, also yes, in that they don't cost a lot. So I have speculated on Options Playbook Radio. The biggest one that I probably speculated the most on is looking at butterflies, skip strike, whatever type of butterfly you want to talk about, but looking at doing them in a situation like Amazon where the pricing conditions would be, would behoove you if you're correct on your forecast. Just almost a lottery ticket type trade is what you would be looking at, 100% speculation, but the pricing conditions are right to consider a one-day trade in a stock like Amazon around earnings.
All right, let's keep on rolling. See how many of you folks we could squeeze in. So many of you folks waiting, trying to get you all on board here on the huddle. Let's go out to Mark. Oh, Mark with the C. Can't trust a Mark with a C. We all know that. Mark's with the K. We know we can't trust a Mark with a C. They're dubious. Mark with a C wants to know, how much time should I spend on my trading every day if I really want to be successful? I have a full-time job that I'm not looking to replace, but I really like to make trading a viable side position for myself and a way to augment my income. Interesting. We haven't gotten a question about, usually the question is, how do I become a full-time trader, that sort of thing. Sounds like that's not what Mark's looking for. He's looking for, I guess you can call it a viable side hustle, Brian. How much should he be, in terms of time, should he be spending on his trading every day if he wants his options trading to become a viable side hustle for himself, sir?
Wow. I mean, that's just such a tough question. And I might even just punt it back to you, Mark. Overall, you might have a little bit better of a feel for it. You got to look at it every day. You got to follow the market and have a plan and find a way to execute that plan. So the hardest thing to do with option trading is to try to take the emotion out of it. So if you're not looking at it and spending, if you're trying to make it a viable side hustle, if you're not looking at it at least an hour a day and always have it on the background and have alerts set, then it's really tough to do. So if you have a job where you can't leave at the moment and go and do something to adjust a trade or even exit a position, yeah, that's a tough one. I guess when you say a viable side hustle, I don't know. What would you say? I'll pass it back to you, Mark.
I had a feeling you're going to punt back to me on this one. I can just tell. I've been doing this show with you for a while now, Brian. But yeah, it's interesting. I'm kind of biased in this because obviously I want people to spend as much time listening to my content as possible, Brian, right? So yes, I would say many hours a day, thousands of hours. But in reality, I get it. You have a full-time job. And it's funny you say that because it's not in many ways dissimilar to what I do here all day. Everyone thinks I'm just doing nothing but slinging options all day. But I've learned over the years, it's very difficult to do so when you're actively hosting a show. You've heard some of my other cohorts like the Rock Lobster and others and Dan try to do it sometimes. And you hear those little pings, those little noises in the background. Usually doesn't work out that well for them either. So I'm not that dissimilar of a boat from you there. Who was this? Mark with a C. And that, I can't be nonstop looking at my screens all day too. I could, but then there'd be no content for you guys and the business would fall apart. So that has to be the focus. So yes, I'm sometimes find myself looking at trades where I know I can't babysit them for a little bit. I'm going to be busy for a couple of hours doing other things. So I like strategies that are conducive to that. What we were talking about earlier, butterflies, risk mitigated type trades, that's usually my approach. Very rarely am I going to go blast out some sort of naked option unless it's a pretty attractive put, let's say, in a name at a level I'm already comfortable buying it at, in which case you've kind of done your due diligence already ahead of time because you've identified a level where you're comfortable buying the stock. So a short put trade like that can also work out. You don't have to babysit it all the time. Some of these other trades that, if you're going to be slinging long at the money straddle, something like that, you got to be on top of that all day long. So that would definitely recommend you adjust your trading style to accommodate your lifestyle. But also, as Brian's right, you need to be at least have this stuff, let's say, on in the background while you're doing something else. You need to be engaging with market content. It could be ours. It could be anyone's, as long as it's something that's keeping you engaged with what's going on in the market. Because if you want to make this a legitimate, quote unquote, side hustle out there for yourself, then you have to put a little bit of effort into it. So the thing about time is it's subjective. Is that time directly trading? Is that time consuming content and learning and educating yourself? That's also very valuable. So I definitely recommend that. You don't have to be just looking at screens. Educating yourself is also an extremely important aspect of that. So if you add in all of that, then I'm going to say, yeah, at least an hour a day, I think is a pretty good ballpark. Sounds like you've arrived at that yourself, Mark. So if you can squeeze in an hour a day, I don't know, maybe you're a teacher in between classes, whatever it is you do, you can have time to check the markets, check some of your positions. At night after work, you have some time to catch up on markets and to educate yourself about options, whether it's reading the playbook, whether it's listening to the show, whatever the case may be. As long as you have time to take advantage of that, then I think you can make this a viable, quote unquote, side hustle. It doesn't have to be not everyone needs to be a full-time trader. There's a lot of other things that people want to do and need to do throughout the day that are important. So yes, I think if you want to make it a viable side hustle, I think that's a good road, good starting place, an hour a day. And then you find how that works for you and maybe you adjust it. I'd be curious to the listeners if you have suggestions on how do you make this work for you, given I know a lot of even our pro members, they have full-time jobs, they're doing other things, they're listening on the side. What do you guys do to make it work? I'm curious how you balance that because it's going to be different for everyone depending on your job and what you're looking to do. But it's an intriguing conversation. I have a feeling maybe Mark with a C, we might come back to this on a future show. Here's a timely one, Brian. Now let's go out to this one from Sacramento, CA. So the whole city of Sacramento, California is writing to us with this question. They want to know, is there any way to play hurricanes using options? Well, Brian, we are recording this right as Hurricane Ian is making landfall right now on Florida. I hope all of our southern listeners, I know some of our pro folks who are from Florida, I don't see them in the chat today, so hopefully you're all doing well, you're hunkering down, or you got the heck out of Dodge, hopefully ahead of this thing, this monster coming into your neck of the woods. Brian, I know it's heading your way in a few days or so hopefully you guys are hunkering down there. In the meantime, Sacramento, California wants to know, is there any way to play hurricanes using options, sir?
And Sacramento, that's interesting. Well, I mean, options are insurance products, and if you were going to play hurricanes, you'd have to find something that you would assume would be affected by that hurricane. You could even do it on insurance companies. That might be one thing that you would want to trade options on. But I can't buy a put on the weather, and I can't buy a call on the weather. So the only way to do it is to find companies that may be affected by it. If it's in the, maybe it could be affecting commodities. It could affect the price of oil if it's going to land in Houston, Texas, or something like that. So there are ways to do it using options. I maybe would do it more so. When I think of it, when this question makes me just think instantly of using options to insure a portfolio and protect yourself. So that's really the only way to do it. I can't buy an option on the Weather Channel, I guess is the way to say it.
Yeah, I'm with you on the commodity front. I think that's usually the most direct way to play these types of things. Like you mentioned, the energy WTI is up over 4% today, 4.3%. So nice little pop out there. There usually are these short-term disruptions, as they're obviously this is hitting directly in the Gulf where a lot of those oil rigs are. So they'll have to shut those off. That's going to have a near-term boost to the options. Of course, none of this is new to the options traders or the options market makers. They're going to price this in ahead of time. So if they're seeing this storm coming, you're going to start seeing that priced into the call wing in WTI earlier on. So to think that there's some sort of free lunch, you're going to come in, just scoop up these calls, they're probably going to be reflecting a hefty premium already for this. So just bear that in mind. There is a good chance you could come in, and if you're not careful, dramatically overpay for some WTI calls, for example, and then you end up getting a pop, but you already paid too much for vol. We've talked about that many times on this show. It ends up being a losing trade. The other big one is lumber. Lumber usually is a big driver pre and post hurricane. Problem with lumber is it moves a ton. It was one of the most active commodities on the planet last couple of years. Just listen to our TWIFO program. It's in our movers and shakers just about every week. The problem is it does about 3 options contracts a week. It is not an options entity at all. So unless you want to be the one person doing the one lot in lumber, I would not recommend lumber. So Brian mentioned the insurance companies. That's a way to go. That's a large play. Maybe a little bit more challenging. Might be a little bit of a lagging play there, but you can do that in a securities account. If you want to go the commodities route, you can trade a future or futures options. And a near-term pop in WTI might be an intriguing way. Just remember, this is not an unknown science. People know this is coming. So whenever you have a known event, it's usually going to be priced into the option. So just bear that in mind. All right, Mr. Brian, that music means we've come to the end of another huddle. I like this. This is fun. We got to do it more often, Brian. What do you say?
Well, definitely. Yeah, we got way too many questions. We got to get to them.
Got to get to them. People like Ethan and the rest are not waiting for a month and a half for us to get our act together. But in the meantime, Brian, in between episodes of the huddle, if folks want to check out what you and the folks are over there at Ally are up to, where should they go? What should they do?
Well, the easiest thing to do is just follow me on Twitter. I tweet about all the educational events that we do here at Ally Invest. And my handle is very simple. It's at my name, at Brian Overby. And once again, if you have any questions, you can email them to me at theoptionsguy@invest.ally.com. Want to tell everybody thanks for listening. Mark, thanks for hosting. And until the next time, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.